It's getting uglier by the day. Japanese businesses shut hundreds of stores and factories in China as anti-Japan protests flare up again. Tensions running high as the two sides get no closer to solving their territorial dispute. Let's get straight to Tara in Hong Kong. Just how widespread are these demonstrations, Tara?
They are widespread, Axel. It's not in one or two cities across China today. It is in cities across China. And if you look at the pictures, widespread discontent. September 18 is an important day. It is the day when back in 1931, Japan began to invade China, and this is always remembered. So some people are tempering this as something that was expected to happen today. But if you look closely at the pictures, you can see that aside from a lot of people in the street, they're being allowed to protest. In some cases, you see military people lining the protests. We've seen police actually helping to bus people to the Japanese compound in Shanghai. So really, this is something that is unwinding. People are expecting it to reach its height later on today, but it started very early in the morning as well. So a difficult day across China.
And what I see a lot of Chairman Mao placards. What's with those placards?
Well, that's interesting. I mean, some people are saying it's a representation of the Communist Party. Other people are reminding of the nationalism and that maybe China should be harder on Japan. There's also some very harsh slogans being shouted and said as well. People are really emoting, and this is a lot here about nationalism in China.
Very quickly, the wider impact on investment in China?
Well, we're definitely seeing major Japanese firms take a hit today. Toyota, the retailers are taking a hit. They've had to shut down operations across China today. But if you look at the wider indices, they're not too bothered at the moment, thinking that this will blow over, at least in the short term. Palladium taking a hit today because of automakers in China. But people are waiting now to hear about long-term repercussions before they really get worried.
Okay, Tara, many thanks. Other headlines on Reuters this morning. Apple sold 2 million units of its new iPhone 5 in the first 24 hours of sales. That more than trebled the company's previous one-day record. Apple shares touched $700 in extended after-hours trading. And big moves on oil markets, puzzling market watchers today. 4 minutes of hectic trading saw crude prices drop by $4, with traders scrambling to find the reason. Fat finger trades and technical glitches among possible explanations. Let's get straight to Alistair McCaig, market analyst at IG. Morning to you, Alistair. What do you make of this move? And is it actually what we're seeing now indicative of a post-Bernanke shift?
Morning, Axel. Yes, it was pretty aggressive and pretty swift, the oil move last night. About $4, 4% in relatively swift terms, 2, maybe 3 minutes. There was rumours of fat fingers trades going on, which were relatively quickly poo-pooed and put to bed. There was also talk of October option expiries coming into play, and maybe that was part of the reason. It was pretty aggressive, and it just showed how quickly the market lost confidence and saw the price fall away.
Just on the back of Bernanke last week, we talk about whether he convinced the markets enough. Is the risk on sentiment over for now, would you say?
Well, I think one of the things we saw on Friday and to a latter extent Monday morning was not the sort of buy the rumour and sell the news trading action that we'd seen. We held relatively well on Monday, but we didn't move on. There was certainly no confidence in the market to move and take things a step further. It was more a bullet dodged rather than a big step in the right direction taken.
So what do you say is going to happen to these equity markets from here till the year end?
Well, again, we're slightly softer this morning. We're looking around at it again. And I guess the markets are really looking for another piece of news that's going to make them convinced that the the problems that we've had, not just with the Americans, but also with the Eurozone, is being tackled and being dealt with. I think we looked yesterday and saw sovereign debt, specifically the Spanish 10-year debt yield, crept back up to that 6%. That's not the sort of the level that really is the make or break. That's 7%, but it traded back above 6%. And I think when you look at bond yields, that gives you a much more vanilla, a clearer picture of what the market really believes the economy of those countries are doing. If you look at indexes, they can be slightly manipulated by one or two stocks doing particularly well. But when it comes to yields, you get a very clear picture of the economy.
Let's get a quick word for you on, from you on the UK inflation numbers due out later on. How relevant are these, again, post-Fed?
Well, to be honest,